Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name's Tom Rosine. Thanks for joining me today. I'll be reporting flows for the weekend in August 6, 2014. Investors actually injected about $1.4 billion into the conventional fund business, but we'll find out later on it really was all money market funds. It was kind of a dour week overall. Basically, we saw, Russian-Ukrainian situation kind of develop even further. Russia's doing a little bit more saber rattling, putting their troops, massing about a bunch of troops off of Ukraine's eastern border, and that caused a lot of concern. We saw some news out of Europe that, first of all, Italy slipped back into a recession during the second quarter, and Germany actually had some manufacturing numbers that were lower than expected. They dropped about 3.2%, and that put a kind of a damper on the mood of funds overall. And while seeing this, and people are concerned about the Fed, we saw that the S&P 500 actually suffered its worst one-week performance, ending August 1st, by the way, that they've seen in 2 years. So it really just was kind of a bad week for funds overall, and actually for the market overall. And we'll see that kind of translated through to our macro groups. Let's go ahead and move on to our macro groups and find out how the flows were. Equity funds saw about $600 million in outflows, which doesn't seem to be a lot, but when I break it out, you'll see that actually the numbers were pretty big. Taxable bond funds just got clobbered, though. We saw about $5.8 billion in outflows. Community bond funds saw a little bit of outflows, a little bit less than $100 million in outflows, and money market funds actually saw the only inflows in the group, about $7.8 billion net new money coming into their coffers. Well, why don't we go ahead and take a look at how the economic news translated to equity funds in particular. We saw that they were down 2.36% for the week. That's a big number. It's the fourth week in 5 we've actually seen negative returns. And again, like I said, for the second consecutive week, we've seen outflows, this time to the tune of about $600 million in outflows. Now, how this broke out is domestic equity funds actually saw outflows of about $2.2 billion, and that's the fourth consecutive week they've seen outflows. If we take a look at non-domestic equity funds, where some of the problems are actually occurring, we actually saw inflows, about $1.6 billion net new money coming into their coffers, and that's the 34th consecutive week that we actually have seen inflows into this group. So it's kind of amazing. People are actually ducking for cover, thinking maybe that the equity market's a little bit overvalued, at least in the U.S., and looking overseas for other opportunities, and perhaps emerging markets, with the exception of Russia, might be that place to go. Well, as we broke this out again, what I took a look at was for non-domestic and the domestic equity funds, what was the major contributor to outflows or inflows? Well, if we take a look at the outflow scene, large cap funds actually suffered the largest outflows for the domestic equity group. About $1.4 billion exited their coffers. Now if we take a look at non-domestic, we see that the equity funds, international equity funds, actually saw about $1.7 billion. And as I was making reference, actually emerging markets saw a little bit of an increase as well. About $600 million of funds, new funds, went into their markets as well. So this was kind of a change of pace. Well, let's see how this actually translated over into the ETF universe. We'll see that there's actually a fairly big change. For the second week in 3, we've seen outflows, this time to the tune of $15.8 billion. That's huge. It's the third largest on record that we've seen. And how this kind of stacked out, if we take a look at the breakout, iShare, Core, S&P 500 actually saw about $1.6 billion in net new money come into their coffers. Consumer discretionary select spider funds saw about $1.4 billion. But on the flip side, if we take a look at the bottom, huge outflows out of SPY, the S&P 500, Spider S&P 500 fund, actually, it's the largest fund out there. So anytime we have big movements, we see big movements out of it as well. This time we saw the second largest redemption out of that group. It was at $13.9 billion. And then we take a look at iShares Core S&P mid-cap funds, saw about $1.4 billion in outflows as well. So really, when we put this story together, it was a really big week for outflows, particularly S&P 500, SPY actually suffering the biggest redemptions out of the entire group. Let's take a look at how fixed income funds fared in this market as well. Actually, for the first week in 31, we saw outflows, about $5.8 billion. This is the second consecutive week we've seen outflows. And if we take a look, we also had about a it's the second consecutive week we've actually seen negative returns in this group, about 0.48% decline. Now, if we take a look at the breakouts, corporate investment grade debt funds actually took in a little bit of money, about $96 million, almost nothing to talk about. Often we refer to that amount as a rounding error. But it was the 14th consecutive week that we've seen inflows in this group. Loan Par, which is a subset of the corporate investment grade debt group, basically saw about $1.3 billion in outflows. It's the fourth consecutive week, and it is the largest since August 17th, 2011. So for this, it was a big amount of money coming out of it. However, the big story is, while equities were suffering some big outflows, we actually saw also high yield funds just get clobbered. $5.8 billion out of their coffers. Fourth consecutive week that we've seen outflows, and this was the largest by far that we've seen in outflows from this group on record, going back to 1992. Well, let's go ahead and take a look at the ETF universe and see how that fared. Actually, we're going to see a little bit of a reversal. We saw about $1 billion in net new money come into that group. And it's the third consecutive week that we've actually seen net inflows into bond funds. So this is a little bit different. We get the authorized participants actually putting some money to work. But how we saw them putting money to work is going into treasuries. So this safe haven play. iShares 1 to 3 treasury bond took in about $1.1 billion. And if we take a look at the actual outflows, we saw the iShares JPM US dollar emerging market bond fund actually losing about $0.6 billion. And of course, the next two were high yields that got clobbered as well. So certainly the theme rolled through, but we saw authorized participants actually making that run for safety, maybe setting up the universe so there'd be enough inventory out there to buy for investors to move into those safe haven plays. Let's take a look at another, what we've also considered as a safe haven play, muni bond funds. Muni bond funds actually suffered an outflow. This is the first week in 4 that we've actually seen them have outflows, but it was only to the tune of about $6 million. This is the fourth consecutive week, though, that we've seen positive returns. This week it was 0.23%. And national munis actually saw inflows, about $93 million. So that tells us that really single state munis are the ones that took it down. It had to be well over $93 million to get to that negative $6 million mark. This is the fourth consecutive week that we've seen inflows into national munis for this group. So there is some trend going out there. Again, I think it was a little bit confused, not a lot of resolve as far as going either way with this group at all. Let's take a look at what we had for money market funds. Money market funds for the first week in 4 saw inflows, $7.8 billion. How this broke out, taxable money markets saw about $4.7 billion, and of that makeup, institutional funds saw about $3 billion in outflows, while the retail sector, again, people ducking for cover, saw about $7.7 billion in inflows. And that gives us to the final piece where tax-exempt money market funds saw about $3.1 million of money come into their coffers via that group as well. Well, that kind of brings us to our end, and usually I try to be somewhat philosophical about things going on. Actually, this has been a kind of confusing week. We've had actually really good numbers. We saw that the unemployment rate actually stayed the same. I think it was at 6.1, but we saw it well over about 204,000 net new jobs were added to the economy. We've actually had good numbers overall, so I think people are seeing good numbers, but they're very fearful about what the Fed's going to do as far as easy money goes, taking that money away. And of course now the looming issues in the Middle East and Far East are actually coming to a resolve, coming to a pinpoint as well, and people are very concerned about that. So that's kind of rattled the cages. And this morning, actually, some more good news though. We saw that Q2 non-farm productivity increased about 2.5% from the prior quarter, and that was against analysts' expectations of only just a 1.6% increase for the second quarter. So really, overall, we have good news. And so until we can resolve the issue of what the Fed's going to do, as we get these new numbers in, we got I'm going to say about a third of the reporting groups for S&P 500 to report. But up until this point, we've had expectations, beating expectations about 63% of the time. So we're really in some good numbers. We're really in some strong economic numbers. So really, I guess it's going to be good news, bad news for the market, and we'll have to wait and see how that pans out. So I'd like to thank you for coming, but if you want to do a deeper dive and actually check on areas that I didn't cover in this report, you can go to lipperusfundflows.com and do a deeper dive yourself, or you can wait till next week when one of our analysts will talk to you about flows for the next and upcoming week. Well, I'd like to thank you for joining me. My name's Tom Rosine, wishing you the best in your wealth planning and creation.